at 5 minutes past the hour. What do you say, Ryder? Do you want to kick it off?
Yeah, let's do it.
Let's do it.
Good. Well, welcome everyone. And everyone that's going to listen to this recording, because we are recording this for the people that joined late and the people that missed it. So we're pretty happy to have Dave Van Horn present to us today. We're really excited about that because Dave is authority on the subject of note investing. But what I really like about Dave is that he has more than 30 years of real estate experience. He started as a child laborer, probably. And
he's older than you think.
And he has been a realtor in Pennsylvania. He's been an investor, and he's even been a partner in a title company. He's raised money for commercial deals and a lot of other stuff that would be too long to mention here. What I'm trying to say is that Dave is he has a lot of all-around real estate experience. And he is not just a person that he only knows notes and he only does notes, and that's why notes are the best thing there are. Now, obviously, with his company, PPR, the PPR Note Company, which you see on the screen here, Dave is specialized in notes mostly, but there is a reason for that, because he's been doing real estate a long time, and at some point he figured out that it was more profitable for people to be the bank. He is the founder of his company, and also he is the person at the company that's responsible for getting the good word out about notes and what people can do to participate in that, to make money on that. And probably towards the end, Dave will also share with you, once you're convinced how awesome notes are, he'll also share with you how you can participate through his company if you choose to do that. Did I leave anything out, Dave? That
no, not really. Actually, you covered it quite well. And no, thanks for having me. I think it's great. I'm out in Philadelphia, just for folks who are wondering where I'm from. And I grew up in the area, so I'm from this area. But I do travel quite a bit, and I do get out to the Bay Area and pretty much all over the country as well. Tonight I was planning on talking about some investment strategies with notes, obviously. And you did touch on about, who I am and what I do. And I'm president and CEO of PPR Note Company. And basically we're fund managers, right? We manage several mortgage investment funds, and we invest in 1 to 4 family residential mortgages nationwide. And that's primarily the sandbox that we play in, right? And we were founded in 2007. We started out as just investors. And a lot of what we do, it started out as investors, but then it kind of morphed into, a club and then a business. And today, we're probably more into community stabilization. So we started out with 4 loans, which isn't very many, right? And today we have thousands of mortgages. We're probably about 120 million under management. We're probably looking to deploy 120 to 180 million next year in first mortgages. So give you some kind of sense of scale there. We deal with a lot of REO properties. So we own, hundreds of homes at any given point throughout the country that, a lot of times we're liquidating like a bank would liquidate, that type of thing. So, before I go too far, though, I kind of want to make sure everybody knows what a note is. And I say that in a funny way, right? But it wasn't too long ago that, I thought a note was a musical symbol. I thought a loan meant to be all by myself or whatever, these bad jokes that I'm telling right now. But a note is a promise to pay. And one of the things I like to start out, reminding people is that, we're all in the note business, whether we believe it or not, right? There's student loans, auto debt, medical debt, it goes on and on and on, right? Mortgages, obviously, credit card debt. So there's a lot of notes that are all around us. We are in the note business, whether we realize it or not. Now, most of us just aren't paying attention to it, or we're writing a check to a bank, we don't look at the note business as an investment vehicle or buying debt at a discount, things like that. And we don't know how it applies to us. We just kind of, it's happening all around us. And it's like we let it happen and we don't even realize what's going on. But we're really all in the note business. I know hard money lenders and private money lenders, if you really think about it, they're in the note business as well. So, you know, hopefully that makes sense. But when I'm referring to a note, I'm really referring to a note mortgage. And by that, I mean, usually, you know, residential for the most part. We do some commercial notes and things like that. But as PPR, though, it's pretty much residential notes and mortgages. So to simplify what we do at PPR, it's pretty basic. We're private equity. We pool capital together from high net worth investors. And then, you know, my partner, John, runs our acquisitions. He's our VP of acquisitions. He goes out to market, whether it's through trade desk, government agencies like HUD, Fannie Mae, Freddie Mac, other funds. We buy from some large, you know, investment funds as well, from servicers, those types of things for various trade desks. So we go out to market, we buy pools of mortgages that are usually, you know, almost all are non-performing. Sometimes we'll get some scratch and dent, like sub-performing types of mortgages, but primarily we're buying non-performing. And then, you know, once we acquire them, now it becomes an asset management play, like I was referring to. And it's really two things typically go on, right? You're either exiting your deal through the borrower or through the property, right? And through the borrower, I mean, you're, you know, hopefully doing some type of modification. If we can keep a borrower in their home, by all means, that's what we're going to try to do. And the other side is, you know, we're going through the property, we're liquidating the asset. And I know most people don't want to see a boarded up home down the street from them, you know, with the 2-foot high grass and all that kind of thing. And our goal is to get that asset back into circulation, back on the tax rolls as quickly as we can, really. That's pretty much our goal. We also do what's called surveillance as well. So sometimes we have asset managers who monitor servicers so that we can handle more volume. So, so not only do we do asset management, we also do what's called surveillance. And then, of course, what everybody wants, right? The payment, like how can these guys pay us a return? And it's really through exiting through the assets one way or another, right? And there's, you know, sometimes we're getting homeowner payments, sometimes we'll get a cash out, refinance people. We do short sales. Like a lot of times, you know, there were times when I used to approve all our short sales. I don't know if anybody on the call is familiar with short sales. We used to call them long sales, right? And then there's, we can sell the note, we can sell the actual property if we take it back. You know, they're just a few of the examples of how we make money off the asset. And then obviously that's how we're able to pay, you know, the preferred returns that we pay, right? So, so some of the things I was hoping to cover tonight, because most of you know I wrote a book called Real Estate Note Investing. I don't know if you can see that on the little screen, but through Bigger Pockets. But obviously I can't talk about everything in the note business. It's funny. Sometimes people will say, I want to learn everything there is about notes. Well, that's like saying I want to learn everything about real estate, right? Which is pretty hard to do because real estate can cover everything from cemetery lots to REITs, right? So how are you going to do all that? And it's the same way with the note space. It's huge. It's $1 trillion industry. But tonight I figured I could cover a couple topics that maybe keep people from falling asleep out there in the Bay Area. One is how to recession-proof your investing utilizing notes, which is kind of a popular concept right now. And the other is working your capital. So I don't know, I picked those two topics out of thin air. So hopefully nobody minds. And when I refer to recession proofing, what I mean by that is I'm from a school of thought that we should be recession proofed all the time. Like right now you're hearing this banter in the market. You hear people on the news about the world's going to collapse and then we're all going to, you know, keel over or whatever. But the reality is I think investors should be ready all the time. They should be ready for market changes all the time. They should be ready for a recession all the time. And, you know, there were some of the things I wanted to allude to. Where am I? There you go. at one time, I have a strong real estate background. You referenced that. I actually got into real estate when I was 26, 27 years old. First got licensed. And there was a long period of time I thought the perfect investment was real estate. Later on, I thought it was notes or investing in note funds and those types of things. But what I quickly realized is it's more about asset allocation than the perfect investment, because there's really no such thing as the perfect investment, right? And a lot of people don't know this about me, but I do a lot of other things besides PPR. Now, PPR itself is over 20 entities. There's multiple funds. We've had over about a dozen funds. We have a servicing arm. We have an REO company. We have a licensing arm. We have holding companies. We got management companies. It goes on and on and on if you were to look at our schematic of our organization. But I also have, I probably have about over 40 companies altogether. So I'm well diversified into other businesses. My first business was Van Horn Painting. And actually Van Horn Painting's been around for 28 years. And my oldest son runs Van Horn Painting today. I also own a drug and alcohol recovery center outside Philadelphia. I've owned it for 10 years. So there's other businesses that I have that people just don't realize I have. My IRA account owns a management company that day trades. A lot of people don't know that. So I believe in having multiple investment buckets. Not only do I have a real estate portfolio and a note portfolio, I also do some syndication. I've been syndicating over 20 years. Started out syndicating for commercial real estate before I even got into notes. So I had been doing mobile home parks, storage centers, commercial office condo development. So I've done a lot of different things over the years. I'm giving my age away probably, but but today, I'm in a multitude of different buckets, so to speak. And I do a lot of different alternative investing because I run a high net worth group called Strategic Investor Alliance. And we do a lot of alternative investments, everything from insurance contracts and life settlements to ATM machines to you name it. And I'm a firm believer in utilizing your qualified plans and your insurance contracts, any types of tax favored investments. So I look at the whole picture, right? I'm not just looking at notes, so to speak. Now, a lot of people find that funny because aren't you a note guy? You should be pushing notes, right? But I don't. I actually do a lot of different things. So to me, it's more about asset allocation and some diversification as well. But one big thing for me is liquidity, and this isn't really an asset class, right? And I want to just touch on the importance of liquidity briefly. And when I first started in real estate, I had this guy that was training me. And you know how you look up to somebody who he was like top dog in the company. We had a couple hundred agents. There were 7 offices. And this guy was the #1 guy. And he's training me, right? And I'm like, wow, this guy's amazing. And he had about 25 rental properties. And he says to me, he wanted to sell me one of the properties. So I go out to look at this thing. And I come back to the office. And I'm like, that place was a train wreck. What was that thing you just showed me? And it turns out I didn't expect it because this guy's a flashy dresser and all this stuff. And next thing you know, he's losing all 25 properties. He files bankruptcy. He gets out of the real estate business. And then I never see this guy, Jim, again, right? But it taught me a lesson. He had no reserves. He had no liquidity. He had the wrong type of financing on his properties. All these things that he was doing basically wrong. He was buying all these properties like FHA owner occupied. And back then, this was before the MLS was in computers. We had photo books and they didn't have like centralized databases to track, people applying for more than one mortgage, that type of thing. So this guy spread himself so thin with so little down. When it came time to make repairs for the township or for Section 8 or something, he didn't have the money to do the repairs. And the next thing you know, he couldn't pay the rent because they couldn't he couldn't rent them out. Then he couldn't pay the mortgage and it snowballed, right? So back then I realized a big lesson in liquidity and having access to cash, having some reserves. And just from being in PPR, right, we're in the default services business, right? And there's 4 main reasons people default. It's death, divorce, job loss, and medical, right? So, I just learned a lot from that. And I realized how important liquidity is and having reserves. And when I first started out buying properties, I always had some reserves set aside. It might be 2-3 grand a house. And then later on, as I accumulated, I had 40 places at one point. It wasn't so much that it didn't make sense to have a lot of money in reserves as you grow like that, but you want to have access to cash. I think it's pretty important and something not to lose sight of for folks. So when it comes to like an investing strategy today in this market, especially, you know, I think there's some things that I've done, and I'm not saying the audience has to do what I did. I'm just telling you, no, I've done okay and I'm pretty successful. So here's what I did, take it or leave it. You might believe it, you might disagree, but these are some things that worked for me, right? And one of them was, this is just recently, this is stuff I've been doing is really fixing or refinancing my properties. And the reason I've been fixing rates is how low can they go? So my parents bought their home in 1964. Guess what the rate was? Come on, give me some love here.
18%.
No, it was 4.
Oh, wow.
So it was 4% in 1964. And what are the rates today? Not that far off of that, right?
About, yeah.
So how low can they really go? Now
Well, according to our president, they should go negative any moment now. Did you read that?
I promised I wouldn't talk about politics or religion until after the show. No, I'm only kidding. But no, and I'm not necessarily a person, just to give you guys color, back at the downturn, I literally had half my portfolio with interest-only loans and adjustables, and I had half my portfolio with fixed. And guess what crucified me? My fixed rates. I had 7.5s and 8s. And you know what saved me? The 3% properties. And I was like, why didn't I stay with? So you never know. And it stayed that way for like 10 years. And you couldn't get out of them. I couldn't refinance them. They would say you have too many properties, blah, blah, blah. You get the idea. So, but in this environment, I think it's probably a decent strategy to think about. If you plan on holding the property, it might make sense to fix your rates or refi to get at some of the equity maybe. I'm going to talk a little bit about that. But developing access to cash. There's plenty of strategies to develop access to cash. It could be even more credit card access. It could be just having the ability. It could be business lines of credit, whatever that is. And you want to do it while you're healthy. You want to do it while your income's good. You want to do it while your credit's good. You don't want to have to be trying to do that when that isn't the case. And even if it's private money, I talk to a lot of real estate investors and they talk about building their buyer's list. Hey, that's all good and all, but what about your money list, right? I mean, that was what was a game changer for me. I've been raising capital a very long time now.
Also, a great example of that one is a HELOC on their house. Like you said, get one when you're healthy and employed and everything is going well. Get that HELOC in place. It costs you next to nothing to maintain it if you don't use it, but you have that access when you need it.
I'm actually going to touch on that in a minute from a little bit different angle. But yes, it's definitely getting this access to cash, building up reserves, employing asset protection. You know, at one time, for a short period of time, I had sold insurance and did a little bit of financial planning, not for a long period of time, just for a couple of years, but it was just enough to be dangerous, to learn enough of what to do. And, sometimes it's the way you title things. Sometimes it's utilizing trust. Sometimes it's setting up some estate planning. And I think a lot of people, they shy away from it. They don't want to deal with it or talk about it or think about it. But I think if you can employ some of the right asset protection strategies, it makes sense. And, you hit about like the HELOC. One of the advantages of HELOC, for example, is asset protection through debt. And a real estate attorney taught me that years ago, probably 25 years ago now. This gal, she goes, even if your house is paid off, you want a line of credit against it. So, now these numbers may sound small because you're in the Bay Area. Instead of 500,000, I should say 5 million probably. But if if my home's worth 5 million, I might want to have 4.5 million against it, But out here on the East Coast, it might be 500,000. And I'd want 450 in whether it's a first and second combined at loan to value of 450. Why would I want to do that? Because if I only owed 100 grand on that other 400,000 is exposed, that equity, if I were in a lawsuit, something like that. And God forbid I get lung cancer, go down to the bank, apply for a loan, and they go, well, you don't have a job. You've been out of work for 9 months. Now I have all that equity. It really protected the bank. It didn't really protect me, right? And what's that saying? What's the rate of return of the equity in your house? It's 0. So that's the asset protection through debt. The other component of that is liquidity. Even if I wasn't going to use the balance of that money, the difference between the 100 grand I had on my first mortgage and, the 500,000 of value, a line of credit at the county courthouse, it's going to show I owe that debt. That's what I mean by asset protection through debt. And that liquidity component, it's valuable, even if I have a zero balance, because, I can access that money if I need to. The one thing another lesson I learned long ago was, I used to do this. I used to tap into my line of credit and go buy other property. Today, I don't really do that. What I do is if I'm trying to buy other property, I'll go use private money or even hard money. And what I'll use my lines of credit for are shorter term, more liquid things like notes or hard money deals. And what I can do is grow my wealth twice as fast. Because by not using my line for my real estate and using someone else's private money, I can do twice as many deals and grow twice as fast if you follow that logic. Also, it's less risk. I had a plumber buddy that I grew up with who he had like $1 million property, lived there with his wife and his kids, and he buys this cheaper house. It was like $100,000 house in the next county over, and he's rehabbing it. He took a heart attack. He's my age. He was out of work about a year. He almost jeopardized his primary over this little crappy rehab. Whereas if he had just used private money, he could have given the house back to the lender or whatever, and he wouldn't have really jeopardized his home. So that taught me a lesson when I watched that, because a lot of us think we're saving a couple points in interest rate, but are we? Because if you're doing the deal quick enough, it's short term, and sometimes the higher rate on the private money will help us make us get the project done too, right? So it works both ways. And then rebalancing and diversifying, looking at your investments periodically, going back, that type of thing. The next part I wanted to touch on was working your capital. And, is your money working as hard as you do? Are you optimizing and maximizing everything? And what finance hacks are you currently employing? I know my buddy, he's out in the Bay Area, George Antone, who talks about all these finance hacks, for example. A lot of time, what changed the game for me when I got into note investing and some of the other stuff was, I was well on my way to having 100 homes, and I thought that was the way to go. At first I started out as, my goal was to have one house a year, right? I'm sure you've heard people say that. And, I worked 2 jobs. I worked one job to live on and one job to bank the money to go buy a house each year. And then it became, I want to own 100 houses. And you heard me say I got up to 40. Well, I never made it to 100 in the true sense of Dave owning the 100. And at the time when I had 40, I was a property manager at a RE/MAX, and I was managing a lot of units. But I started doing lending, and I'm doing lending over here, and then I'm doing the houses over here. And what do you think was happening? I'm going to court every week. I'm dealing with evictions. I'm doing all this stuff. I'm dealing with inspections. I was like a full-time inspector not getting paid. Well, when I had the note space, I didn't have any of that, and it was more scalable for me. So it kind of shifted. And what I figured out was if I could figure out the financing hacks and the financing strategies, I wouldn't need to own as many properties and still make enough cash flow and still make enough money and have a lot less stress, right? So that was really what ended up happening for me. So that's why I say if you can work your capital, it can be game changing. I mean, it's definitely going to, if you can get your mind around some of these strategies, especially once you get the liquidity component out of the way. And by that, I mean, not just the reserves and setting up access to cash, but having the basics in place. A lot of people, they don't have insurance. They don't have disability insurance. Hey, how much should I invest in my first deal? But I don't have any, I don't have any money saved if I lose my job. I don't have, I mean, you see it on Bigger Pockets and stuff where people are starting out and they're like, hey, I love to see people invest real early, but come on, you got to have some basics in place, right? But once you get those basics in place, then you can start doing some of the other things like, accelerated pay down of debt and that type of thing. And by that, I don't necessarily mean, sending extra principal or bi-monthly mortgages or weekly mortgages or whatever they call them. I'm really talking about like utilizing sweep accounts, those types of things where you can pay down a 30-year mortgage in 10 years and things like that. So over the years, I did a lot of those types of strategies where I did accelerated pay. It's funny, I would do an accelerated pay down on one property that I planned to keep. Then I'd have another property I'd have an interest only loan on it. I'm cash flowing out the wazoo on it, right? So I'm doing one thing on a property I don't intend to keep just to maximize cash flow. And then other properties I'd be accelerating pay down and things like that. But a lot of the time I was in acceleration mode, just acquiring a lot of property. And I didn't really worry too much because I had been an insurance agent. So I didn't really worry about paying properties off per se. And I had an accounting background. I actually I was an accounting major for 3 years in college, but just didn't like it. But my point is, it didn't matter when I paid off properties. If I have $5 million worth of insurance, who cares when I pay them off, right? It's almost irrelevant, especially if you have earned income, that type of thing. So I think people need to look at the whole picture of what they're really doing. Another one for me was working your equity and investing the equity. And you touched on that with the HELOCs, right? But I think a lot of folks, they'll look at ROI when they buy a property, return on investment, but they're not always looking at ROE, right? Which is return on equity. Like right now I'm selling 3 properties, and the biggest reason was taxes went up faster than rents. Picture that, right? And I'm like, these properties aren't that great anymore. Like I had to go back and look at my portfolio and go, you know what? There's a couple lemons in here now. They were good properties when I first got them, but I have properties I've owned over 30 years, which is crazy, right? But you sit there and you look at some of these and you're like, you know what? This isn't that good a deal anymore. I'm better off repositioning that equity into another investment, right? And the other one that
the opposite can be true as well. I have some properties where my cash on cash returns are extremely good, but if I look at my return on equity, because the value the property has appreciated so much, there's my return on equity is actually quite poor because there's so much equity now. And yes, my return on cash is great, but if I were to redeploy that money, even at a lower cash on cash return, I'd make a lot more money in absolute numbers.
Or do both, right? So maybe you can refinance, get a home equity line
that's
on
what
it,
I'm looking
or get a
into
private
right now.
line. Even if you get a business line or a private line and you can access some of the equity and utilize it. And sometimes it's equity in a business too. It's not always equity in a property, right? And the other, we talked about ROI and ROE. One of my favorites lately is ROT, return on time. And that's because I'm getting lazier. No, but what I mean by that is there's an aggravation level to this stuff, right?
We call that the headache per dollar factor. And that's a very real thing that you don't find in any of the books.
Right now we buy, a lot of first mortgages, for example, and we can get a lot of vacant first mortgages, which means I'm really buying properties. And we're kind of capped at how many rehabs we can do or how many rehabs our asset managers can manage other people to do, right? I know that sounds crazy. It's like our asset managers are managing GCs, general contractors. Well, how many can they manage? Once they get up 25, 50, like how many, at some point it gets insane, right? So you got to sit there and look at stuff like we were just awarded a big chunk of HUD loans that were home equity line. They were actually reverse mortgages where the borrower's deceased, which is kind of cool. They can't file bankruptcy or anything, but a lot of them turn into rehabs, right? And they've been sitting a while, and it's just like, yeah, they're great and all, but how many rehab projects? And it becomes to that ROT, that aggravation thing. How much aggravation do I want? You could argue that I make the most money when I rehab that first mortgage that that you take back and foreclose on, versus I make the most money, but I also have to manage the most contractors and deal with a lot of nonsense, right? So it's to your point. Qualified plans and insurance contracts, I touched on that. I think a lot of times, most people know about the qualified plans things, but I think it's funny. Some insurance people say, don't use qualified plans, and some qualified plans custodians say, don't bother with insurance contracts. Well, I find that both false. I find there's advantages to both. You have to have the right tools, and you have to use the right tool for the right job. And that's really what I mean by that. But I think there's always places for certain qualified plans. They tend to have a lot more rules to them. Insurance contracts, the biggest challenge there is the industry itself and the salespeople in it. But once you realize the proper tools that you can utilize, especially with insurance as a bank, that type of thing, especially whether it's a business bank or a personal bank, you could do some really neat stuff. We have a lot of clients that do that where they overfund policies, borrow money out, go buy a note, and the note pays back. You know, a lot of times they get free insurance or low cost insurance that way. And you can do a lot of neat things, even on the business side too. You can have key man policies, and you can have, you know, key employee policies as well. And you can utilize these business banks for investment and business related activity that I think a lot of people, especially in real estate, they tend to have tunnel vision. And I know I was a contractor, I was a caveman, you know, that kind of thing. And it was real estate with tunnel vision. And then, you know, as time went on and I broadened my scope, you realize there's a lot of other tools we can utilize to really work our capital and put things in safer buckets. I mean, I'm sure you all know, I'm in a lot of CEO groups, and you know, you'll see people plowing every dime back into the business all the time. Now, I'm not saying that's not always a bad thing, right? There's times when you have the basics set up, you have multiple investment buckets, and you go, hey, you know what? My business has the best leverage. Because that's a great question one of my coaches used to ask me was, you know, what can you leverage in the next 6 to 12 months that's going to catapult you in your business or your personal life, right? It's a great question to ask yourself periodically. And it could be different things. It could be technology, it could be human capital, it could be education, it could be all kinds of things, right? That's going to catapult you. But I think, you know, we need to really look at some of those things of, you know, what can we utilize that's going to be game changing for us, right? So probably one of my favorites, though, is this concept of assets paying liabilities. And I talk about it a little bit in the book, but I'll give you a couple quick examples. You know, I had a good friend who was putting an addition on his house, and I said, why don't you, and he took a home equity line of credit to do it. And I said, why don't you borrow a little extra and go invest that? And he did. He bought a note, and you can invest in notes sometimes for, you know, 40 cents of the payoff on a RePerformer or that kind of thing. And he bought the note, and the payment from the note paid back the entire loan, paid the payment on the entire loan, and he ends up getting a free edition. Well, that's cool, right? It's cool to get a free edition if you can do it. Or, you know, I've seen people do that, like I mentioned, the life insurance, where they get cheaper, low-cost insurance by borrowing it out and investing it in something else. Because you can borrow the money out of the policy at like 5%. Well, if I'm making 14 on hard money or whatever, I'm making that spread, and that's what helps reduce my cost. And I even saw my son do it with his student loan, right? You know, he took a student loan out, my wife took a student loan out, and, you know, we didn't need the money. We could have just wrote a check for college, but why take our money out of our investments when the student loan rate's lower? So in some cases, it's deductible for people. And, you know, then you can go keep your investment in the market. But when it came time for Junior to pay back his loan, we actually bought a note at a fraction of the money. He basically paid for college for a third of the money, because the payment on the note paid the student loan payment and then some, if you follow that. And, you know, it's a great strategy to have your assets paying your liabilities. And, you know, when I taught that to my son, you know, he's a young man, he's like 22 at the time. And he ended up moving to LA, and he was a writer, and he had shipped a used car out there. And he calls me up one day because the used car went, and he's like, hey, Dad, you got any short-term notes laying around? And he got the point of assets paying liabilities, right? And we were able to get him a short-term 7-year note. It was about $4,500, something like that. It had like a $300 a month payment on it. And he, instead of buying a used car that might last a year or two, he was able to lease a brand new Prius, right? And the note paid the Prius payment. Well, that's pretty cool, because you can lease a brand new car for 6 years, and the note had 7 years of payments, all for the cost of what you would bought a lemon basically at $4,500. What are you going to buy in LA, right? You're going to buy somebody's headache. So that's the power of having your assets, you know, pay your liabilities type thing. But I think, you know, there's a whole opportunity cost to some of these things that I'm talking about, right? How much risk is there without reserves or liquidity, right? How much opportunity is lost by not putting HELOCs in place? And, you know, I think of my parents and my grandparents, they didn't do that kind of thing. You know, they were from the school thought, work real hard, pay your house off, and we'll all live happily ever after, right? And that's a myth. I know I'm still taking care of my mom, and she's well into her 80s, right? And I love her to death and all that, but they didn't work their equity, right? They didn't work their assets. They didn't work their capital. They didn't even know what that meant, right? They were so afraid of their own shadow, right? And the other thing is, just like utilizing sweep accounts. If just think of every property you had, you paid off in a third of the time, right? Instead of 30 years, it was 10 or 12. I mean, that's huge differences in people's lives with the same cash flow. What if didn't use the equity in my properties, right? One of the things, I started out, you may know this about me. I started out buying a lot of properties with credit cards, and it was when credit card cash advance checks first came out, and they didn't have a lot of fees like today. So for us, that was like free money. We were out buying houses, fixing them up with credit cards, and we would move a tenant in, refinance, pay the credit cards off, and then they'd up our limits. And I bought like a dozen properties that way. And the next thing you know, my portfolio jumps up in value and I have a couple $1 million in equity. Well, I started becoming a lender. Well, what if I didn't? And if you think about it, even if I had 2 million in equity and I borrowed 80% of that, let's say 1.6 million, and I lend that out at 14% and I borrowed at 4, well, that's 160,000 a year. Now in the Bay Area today, that might not be that much money, but back when I was doing this, that was a salary for somebody, right? And it was very doable, right? And very passive, pretty much, So when you really think about opportunity cost, that could be huge, right? And it's the same way whether you invest with tax-free or tax-deferred versus taxable, and how many of us pay for things out of our pocket. I play this game where I try not to pay for anything. I pretty much expense everything under the sun, you know what I mean? It's just like a fun thing I do as a pet peeve or whatever. One of the other things I did want to touch on was compound interest, and whether it's the accelerated pay down of debt or whether it's building wealth, if you can compound, I think it's a pretty cool thing. And we have some funds, our note funds, excuse me, that allow the ability to compound. So it's a pretty neat thing. And I'm showing you this, just a quick couple slides on this. If you can compound, the power of it. And I know we all know that, but it is funny when you see it and you're like, wow, it really does make a difference, right? And the biggest point of this slide is start early, right, Chris? It's like if you start when you're 25, look at the exponential, look at the amount of principal you invest versus what your total is, and then look what happens when you're age 50.
That is my biggest regret. If people ask me, what do you regret? That I didn't start like 10 years earlier. I was in the position to do it, and I just thought, I'm just going to work, and then money will come because I work so hard, right?
I'll work later and make more money. It won't matter.
Exactly.
But how do you make that up, that difference? Because you can see the exponential, instead of being double at age 50, it's like 7 times, or something. So, the other one, this one is a quick slide of where if you drop a lump sum in, and it's similar. You can see the difference of, if I drop a lump sum in and then add every year, you can see how it's exponential, how it compounds. And then this last one I was going to show you was, we actually have a fund that's 10%. And you can see, hey, if I invest at 10% for 3 years with compounding versus without, we do cap our investors at $1 million per EIN number, but you can kind of see, hey, it's almost an extra, almost 50 grand extra if you compound versus if you don't. And what we find in our funds too, about 70% of the people do choose compounding, 30%, probably live off the income. We get a lot of retirees, that kind of stuff. And out of the qualified plans, we notice it's almost like 100% compound. It's kind of interesting, but it is, some neat stuff. But so some of the ways to get started in notes, because I do want to touch on that as well. I am on a note call, right? So how do you get started in this business? And one of the questions I ask investors is, before I answer the question, is what kind of investor are you? What experience level do you have? What's your risk tolerance? What other investments do you do? What are you familiar with? Because it is different for everybody. What kind of time commitment do you have? What's your education level? All those things are important, I think. But some of the ways we see people get started, obviously performing notes is an easy one. Anyone can invest in a performing note. You don't have to be, a high net worth investor or not. Pretty much anybody can invest in performing notes. And one of the cool things at PPR is we do have note warranties. So if you buy a performer from us, we have a warranty, which is investment principal minus payments received. So the theory there is you wouldn't lose your principal if you had a performing note go non-performing. And then you have the option to, if it were to redefault, to sell it back to us, or we'll actually refer you counsel as well. So if you say, no, I want to keep it, there's a lot of equity, I'll make more money for closing, we'll help you out if we have an attorney in your area. The second way is through note funds. Note funds are very passive. Our note funds are accredited investors only, but there are other note funds that, that are crowdfunding, anyone can invest. So they're out there as well. There's probably, some people ask me, which is better, performing notes or note funds? And I don't know that answer. I do both. And the reason being is they're different. They're different investments with different risk profiles. When you invest in a note fund, you're diversified, you have limited liability. What else? Now you're investing in the management team, right? And you have to trust that team and that they have access to product and that type of thing. If you invest in a performing note, you actually own the asset. Now that can be a blessing or a curse, right? You might say, well, yeah, I own the asset. That's great. I can go drive by it, look in the windows, touch it, feel it. A lot of real estate investors like that because we're all control freaks, right? We're real estate investors. But the downside can be, you have a lot more liability and stuff with a note. Now, which one will perform better? It's hard to tell. In down markets, for example, a lot of times the notes have a higher yield than note funds. And in an up market, you'll see the opposite a lot of times. You'll see where note funds are paying just as good a yield or higher than the actual note. And with the note, you really don't know what your yield is till you exit the deal. It's funny, I don't really hear gurus talk about that. They try to, they're selling sizzle. But at the end of the day, how do you know? Yeah, you know what the coupon payment is, but how do you know how many of those payments they're going to make? Maybe they miss a payment every year or two payments. And how do you know when they're going to cash you out? Are they going to go all the way to term? Are they going to cash you out 2 years from now? Because the earlier they cash you out, the higher the yield. So you kind of don't know what you're going to make on a performing note until you exit the deal. And usually you're okay. I'm not saying it's a bad investment. I actually do performing notes as well as investing in note funds, but they are different investments, right? When we sell you a performing note, it's already with a servicer usually. Most people stay with the same servicer, which is like similar to property management for a note is what I kind of use that analogy. And they'll do collections and send late notices, and they can do all the servicing things that are required. And then they ACH payments to you. If you're in one of our note funds, we ACH payments as well, first business day of the month. Now, some folks want to invest in non-performing notes. In fact, years ago, we used to teach this. Before Dodd-Frank, it was pretty, I don't want to say Wild West a little bit, but it was less regulated for sure, right? And it was a different world. Today, non-performing, I'm not saying don't do it. I'm just saying be careful when you do it because, I look at my company, we've spent over $1 million in compliance. And there is definitely some regulatory risk in the non-performing note space. So if you're going to do it, be aware of what the laws and regulations are in the state where you're operating from and in the states where you're buying assets. You want to know what the deal is because you don't want to get slapped on the wrist. I have seen note investors get some pretty nice fines, from 50 to 75 grand, sometimes on an asset that they paid 10 grand for. Well, I don't want to see that to happen to anybody. I'd rather see them be compliant and avoid that stuff, right? Seller financing is another way to get started in notes. That's one of the ways I got started in notes at first. I went to my local RIA group and learned about, invest in debt from Jimmy Napier and Donna Bowers and Pete Fortunatos and Jack Millers and all those people. And I did some seller financing before I got into institutional note space. And today I still own second mortgages and first mortgages on properties that I've since sold, collecting payments many years later. And then that's kind of fun, collecting cash flow from a property you no longer own or have to maintain. There's nothing wrong with that. I actually enjoy that piece. Private and hard money was the other way that I got started in the business at first, becoming a private money lender. And I've done pretty well. I still do it on occasion. I don't do a ton of it, but I still do it periodically. Another way that people get started sometimes is in peer-to-peer and commercial notes as well. So by that, I'll give you two examples. Peer-to-peer could be So similar to the lending club type models, but there's other ones. You probably know them more than me. There's probably more out in the Bay Area. But they're crowdfunding for everything today, from hard money funds to real estate funds to, like Lending Club and Prosper and all that good stuff. And it doesn't take a ton of money, right? You can invest 20, 25 bucks. So it's not like you have to be a millionaire to get started in notes. The other thing is commercial notes, which I do some of that too, which is merchant cash advance, where you lend against business receivables. Now you might say, hey, Dave, why do you do that? Well, one of my investment vehicles is that. And the reason I do it is because it's counter-cyclical to the type of notes PPR does. So in an up market, merchant cash advance factoring, it's called often, that's booming in an up market. In a down market, distressed debt's booming, right? So it's just a way for me to invest in two different note vehicles and do well in either market, right? So it's not a bad, it's just my strategy of what I do. So there's some ways that people can get started. You did mention that we do have some fund offerings, and I did want to touch on them. Our short-term fund offering is what we call our Liquidity Fund. And what's kind of neat about that is we offer two different options. One's a 60-day liquidity, which is really short. I don't think anybody really has that in the marketplace. And then we have a 6-month liquidity at 6%. And you might say, well, number one, most people go, well, how can you do that? The banks can't do that, right? And actually, it's funny. I was looking up Vanguard, which is actually local to me. It's right down the road from my office. And that's Vanguard and Fidelity. They both have liquidity funds. And the average for the last 13 years, I think, for Vanguard was 1.9%. So people say to me, oh, Dave, well, that's crazy. How can you pay this rate? That's insane, right? But here's how we do it. Typically, the assets in this fund are reperforming mortgages, and they usually have a coupon north of 12. And you can tell just by the two offerings in that fund that our average cost of capital is somewhere in the 5% range. Well, it doesn't take a genius to figure out if I have 5% capital and I'm making a coupon rate of north of 12 on reperforming loans, that's how you make cash flow from it. And there are two other things that happen, a couple other things that happen. One is we do set aside reserves. And the other is, as time goes on, we get pay history. So if it's 12 months go by or 24 months go by, that asset is worth more. In fact, it will actually start to become worth par, which means full value almost. So, and what else is neat about it is we can sell reperforming mortgages in about 15 minutes. Well, I can't really sell, a multifamily syndication in 15 minutes. I can't sell residential real estate normally in 15 minutes, although I see people attempting to on eBay and stuff. But you get the idea. So this is more realistic than you realize. It's backed by reperforming first and second mortgages. They're very liquid. They've always been liquid. So it's pretty easy for us to be able to offer this type of liquidity to folks. And it's much easier than people realize. So, back to the liquidity fund, the minimum on that is $25,000. It's $5,000 a share, and I did mention that it's $1 million cap. Now, in our income fund, it's a longer term fund, and we have an 8% option for 1 year and a 10% option for 3 years. This minimum investment's $50,000, but both of these funds you can compound in. And the one thing I do want to point out, because compounding works better the longer you do it. For example, if you were to invest in the 10% fund and you decided to compound, your actual yield is 11.6 because your preferred returns are making a return as well, right? So it's pretty neat what compounding can do to that. 11.6 coming from a qualified plan or something could be pretty good for a lot of folks. So, they like the diversification. They like the limited liability. This income fund is backed primarily by first mortgages. And you might say, well, how could you possibly pay 10%? That's usually the questions we'll get. And the biggest way is when we're buying non-performing, especially first mortgages, typically we're making between 18 and 22% on those assets. If we're buying junior liens, sometimes it's north of 30. We just can't get enough volume of junior liens with the amount of capital we have deployed. So obviously we buy a lot of first mortgages, but our cost of capital is below 10. So it doesn't take a genius to figure out, well, that's how they they can do it. That's their spread. And I use this analogy sometimes to explain it. It makes better sense for people. Think about it. In the income fund, we're buying assets. It's almost like if we were to use hard money to buy a property, well, I couldn't keep it for a rental because my cost of capital structure is too high. I have to refinance the property when I'm done rehabbing it, right? Well, in this scenario, we're rehabbing the paper. So we're using a higher cost of capital. We acquire the non-performing asset. We get it reperforming. Well, now our cost of capital is too high, right? We can't afford to hold it. We would have to sell that asset to the marketplace. Well, by having a liquidity fund, we can transfer that asset down to the liquidity fund and afford to hold it, or we can sell it to the marketplace. In the old days, we sold them all to the marketplace. But now that we have a liquidity fund, we have cheaper capital. We can actually afford to hold it, keep it longer, let it season, becomes more valuable. We can enjoy the upside, actually protects our investors even more. So it's similar to that concept, back to the hard money illustration. If I use hard money to buy a house, and I'm done the rehab, well, I can't afford to keep the hard money on it. I have to refinance, or I sell to an end buyer. When I sell to the end buyer, what are they doing? From a 30,000-foot view, they're coming in with institutional cheaper capital because they plan to live in the home for 30 years or whatever. So same concept. We're doing the same exact thing in the note space.
Can I ask you a question on this one,
sure.
Dave? These percentages, is that like a fixed percentage, or is it a pref and the investor actually buys a part of the fund and they share in the profits? How does it?
We just pay a straight pref. No, we don't share upside, and we're in our
fund is basically it backs up the investment.
The fund backs up the investment, and yes, you own a percentage of the company, and you own a percentage of all the assets in the company. And to tell you, we're entering our 13th year. These are audited funds. We've never missed a payment, never been late, never not paid upon maturity in the last 13 years. So pretty solid track record at this stage. We also use third-party accreditation compliance. We use a company, Verify Investor, that because these are accredited only funds. Trying to think what else I could tell you, but no, they've been well received. What we're noticing investors doing is, well, it's kind of neat. They have 4 options with us, right? And I run an investment club as well, and we see funds that are 1 year, right? We see funds that are multifamily, for example, that are 5 year, 7 year, or 10 year, or storage centers, those types of things, and they're great. I do some of that. And they have different characteristics, right? They're longer term, but they have tax breaks, and some are shorter term. And I think we kind of find a nice little niche here with this type of product, because there's not a lot between traditional bank financing and the next alternative investment that starts at an 8 pref or whatever. There's kind of a little bit of a blue ocean there. And one of the things is we've always had liquidity. And now we figured out a way of, instead of just lowering rates, let us offer some of that liquidity to our investors. And they like it. They're backed by mortgages. They can understand it. It's an asset-backed investment. It's a pretty solid alternative for folks to get their mind around. And we have a pretty good track record doing it. So some of the other things is, people want to find out more. They can obviously go to pprnotecompany.com. We do have some education. We don't do advanced courses like we used to. We used to have a course where we gave you a note and walked you through it and all that stuff. But today like I said, I do have a book on real estate and note investing. There's some ebooks and things like that. You can reach out to us. We do some events as well. We have a Mid-Atlantic Summit. We do a pretty good size event on the East Coast in Philadelphia, and we get a lot of people from Bigger Pockets. We have over 400 people coming this year. The cool thing about Philly that you may not know on the West Coast is we're a day's drive from 40% of the U.S. population. So a lot of people don't realize how centrally located Philadelphia really is. We get a lot of people from the New York tri-state area, or DC, Baltimore, Pittsburgh. We get there's a lot of cities there, actually. We also have a note community, which is, we have a distressed mortgages group on LinkedIn. Sometimes you'll see people buy and sell assets on there. And we also do a lot of stuff on Bigger Pockets. There's a note group on there as well. So we do have, somewhat of a note community, especially virtually. and that kind of thing. So I don't know if you guys have any other questions.
It's so this is one of the things I do not believe you really mentioned it that I really like about PPR Note Company. I must say at the moment I own a bunch of notes, but all of those I originated them myself. So I'm like a private lender in those cases. And I've been looking at buying notes, and like many people, you know, you kind of don't know where to start, and it's scary. And you know, like what do you do to break through the inaction? And one of the things that I like that you say on your website, and that we've talked about in person as well, is your guarantee on RePerforming Notes that your company sells. Maybe you want to talk about that a little bit, because I think a lot of people, if they want to get started, and it's not like they don't have any money, but it's like they need to get over that hump. And I really feel that guarantee that you have, that is a great way for people to get started with very limited, if any, downside. The only downside, as I saw it, was like, you know, time value typically. Or can you talk
Sure.
about that a little bit? So to begin with, explain what a RePerforming note is, and then what your guys' pitch is when you sell them.
Well, you know, it's funny. The note warranty is really a marketing thing, right? And a lot of people, you know, same thing. How can you do that? That's, you know, and not too many people have tried to duplicate a note warranty. But if you really think at it fundamentally, it's really just an interest-free loan to the fund, you know.
But can you explain what start with what a RePerforming note is, and then?
Yes. So obviously a RePerforming note comes from it had to be a note that was once non-performing. Otherwise it would have just been a performing note all along. So typically we're buying a non-performing asset. The borrower hasn't been making payments for a while. Usually it's a couple of years when we get them. Our record's 10 years. A note has been non-performing when we got it. And then, you know, we reach out to the borrower, we do a modification, and the asset starts to reperform and they start making payments. And once we get to a certain level of seasoning where they've made, you know, several months payments, depending on the equity in the asset and that type of thing, then we put that asset out to market. Well, we also warranty the note. And what we found was we do get a little bit more for our notes because we have a warranty. And it really stemmed from us selling reperforming junior liens, especially junior liens when there was not as much equity in the place, or not full equity back in the assets. So by us offering a warranty, it made people feel more comfortable, and we were able to offer higher yields. And people really enjoyed the higher yields that we were, especially with junior liens, because we kind of started in the junior lien space and then, you know, morphed into the first mortgage space later on. So with first mortgages, usually the home is your warranty, the home behind the asset. But in junior liens, sometimes there may or may not be enough equity to cover that property, to cover the mortgage, I mean, if you had to go through foreclosure. So that's the warranty helped us sell more of those assets than we probably would have. And we tend to, just by having a good reputation, doing it for a long time. And, you know, we've bought back millions of dollars worth of assets over the years, probably. You know, people trust the warranty. You know, we stand by it. Now, today, to be quite honest with you, the bulk of our reperforming loans are sold through trade desks in large sales. Like right now, we're doing a sale about $12 million. Well, it's much easier for us to sell 12 million in product to one person. So we don't do as much retail sales as we used to. We used to do quite a bit, actually. But then you're doing a lot of little note sale agreements all over the place, right? So it's much more streamlined for us today. We do still sell some retail product, but the bulk of what we sell is in large trades.
Good. Let's see if there's any other questions. If you have any questions, type them in the Q&A box. We have a question from Melissa. She's asking, what is the minimum investment in the income funds? Can you speak on that a little bit?
Yes, the income fund is a 50,000 minimum, and the liquidity fund is 25,000.
Okay, and these are both for accredited investors, and you verify that through the Investor Verify company?
Yes, yes, we use third-party accreditation company. Very quick, easy to do, quick turnaround. from those guys. They do a great job. Yeah, we do cap people at $1 million per EIN number. Sometimes people ask why we do that. We do it to, well, we don't want a family office to dominate us, for example. We don't want someone giving us 30 million and then saying, hey, I want my 30 million back. That would be
tomorrow.
That would be cumbersome. And then the other is to protect investors from themselves sometimes, where they give you too much. Probably some of my larger investors are over 5 million with us, where I start to say, hey, why don't you come to my investment group and see some of the other alternatives, because you do a lot with us. You might want to spread some of that around. Now, it's different for different people, depending on how much capital they have.
Good. Let's see. What I was thinking is, since, like you said, we couldn't cover all the basics of notes, so I was thinking maybe at our next meetup we could do a book giveaway. Would you be on board with that, Dave?
Sure.
Good. Yeah. Then we'll make it into like a contest or a raffle or something, and I will give away one of your books. I have the audio version myself, but that's not very good for a giveaway.
No problem at all. Just let me know.
Good. Yeah, we'll reach out to someone on your staff and get that going, and we'll make a contest out of it.
No, it sounds like fun.
Are there any more questions, Ryder?
Looks like we got one more. Can you invest pre-tax dollars in real estate notes?
Oh, that's a good one.
Pre-tax? Yes, if you're coming from a qualified plan. So many people do that, myself included. I still have notes in my Roth IRA and things like that. So we get quite a bit of, we work with, this is going to sound crazy, but we work with about 35 different self-directed IRA companies nationwide. We probably have a top 3 or 4 that we work with, but we work with quite a few nationwide.
Yeah, Ryder and I, as far as self-directed IRA custodians, the Entrust Group is actually one of our sponsors, and we each have an account there, and I actually own a bunch of notes within that account as well. So the answer is yes, you can invest with pre-tax dollars, provided that you have them in either a qualified retirement plan or a self-directed IRA, or that you can use to, well, basically that you can self-direct.
Yes.
I hope that answers Sherry's question.
I'm interested, do you know, what % of your funds are through retirement accounts?
It's a pretty large number.
Probably a lot, yeah.
Yeah, it's significant. It's probably 35%, 40%. It's a good number.
Yeah.
Yeah, there's a lot you can do with notes. Notes are one of the most popular investments for qualified custodians, for example. We see people doing a lot of stuff with their own accounts where they act as hard money for each other. We call it financial friends, so to speak.
Yeah.
Where, Ryder lends, Chris money, Chris lends me money, I lend Ryder money, and we can all go renovate something. And basically we indirectly got access, right? So there's all kinds of strategies like that to utilize your accounts. You can join together, and you could have 2 parties buy a note and put percentage wise. Now the servicer will charge you more fees. They'll charge you, 2 fees if there's 2 owners. But you can own a note with yourself and your IRA. So you can buy a $100,000 note with 50 grand from your IRA, 50 grand from yourself. You just have to title the note accordingly. And the servicer will send half to each party. You can do all kinds of things like that. So you can also sell partials of the notes. I think you touched on that maybe earlier, where you can buy a note and then you could sell, the next 5 years of payments to someone at a different rate and make a spread on that. I say it like this: everything you do with a house, you can do with a note, right? You can flip the note, you can rehab the note, you can borrow against the note. We actually built our company doing collateral assignments of note and mortgage. And what that means is we would get a reperforming note, and we didn't have any note buyers. We didn't have students. We didn't have anybody. This was when we first started. So we would, raise some money of our own or whatever, or raise some money from family and friends and go out and buy the notes, and then they would be reperforming. Well, that's like watching paint dry. Well, next thing you know, we're like, well, what do we do with these things? So we had investors. So we would go, if you lend us money, Chris, I'll use this performing note as collateral. And we would do a promissory note, and a document's called a collateral assignment, a note and mortgage. And we do a recording in the county courthouse where the property's located to protect Chris's investment. And say Chris lent me money on the note at, 60, 70% loan to value, whatever it is. And then, I'm securing him with this performing mortgage, and by default he could take my note. So it's we raised millions. We literally built our whole company with that.
Very creative.
Yeah,
very creative. I think we've kept it within almost exactly an hour. Do you want to do the sign off, Ryder?
Yes. So let me pull up our meetup, just kind of what we've got coming up on the VIG calendar. Some exciting stuff.
Yeah, well, while you do that, I just wanted to say, like, I've heard Dave speak many times. I've spoken to him, and every time he surprises me with how deep but also broad his experience is. Like, is there anything, Dave, like that has to do with real estate or any derivative that you have not done personally? Like from a contractor to a broker to like it's you always bring up stuff and like he did that too.
Yeah, I had a lot of jobs over the years. Yeah, I owned a title company. I did property management. I was a contractor for a long time. Yeah, I've renovated several hundred properties. Sure.
Yeah, wow, it's extremely broad. Would you think that you suffered from what now they call shiny object syndrome? Or?
Yes, I still do. In fact, my sons corral me every now and then. They're like, "You're not doing anything else. Don't even try it." Like that kind of thing.
Yeah, it sounds like you do quite enough already. Like the one I don't think I'd heard before is your alcohol and drug recovery center investment.
Yes, done real well with that. We've probably had I'd say about 900 gentlemen through our facility over the years.
Yeah, that is quite the business. I heard. Besides all the good works that are being done there, of course, it's as a business. It's also it's pretty good business, I hear.
Yeah, it's very rewarding. There's different challenges, but we've been doing it 10 years now, so it's we kind of have it down. I run that with my oldest son. My oldest son's in recovery, so that is a huge advantage. And it's worked really well for us, and we do pretty well. We didn't really just do it just for the money, but the money seemed to come. And you're right, it is a business within a piece of real estate. And there are people that have recovery places where they don't own the property. I know a gentleman in a couple counties over from me who owns, well, he doesn't own, he leases 11 properties and has recovery facilities. So, but yes, there's plenty of opioid issues out there, and other issues as well. And we see all kinds of stuff. In fact, we get folks from California, Florida, all over, coming to Philadelphia area. It's just, I guess a change of venue for folks,
Yeah, unfortunately, I don't think there's going to be any lack of business in that business anytime soon, unfortunately.
It was interesting when we first opened that we were the only facility in our county, and when you think about that, that's crazy because there's, pretty populated area, and you're like, really? There's none? There's very little facilities in many counties. And it's just I don't know what it is. It's just a lack of resources or will to do it, but we have a waiting list for pretty much all the time. Yeah.
That's
cool.
Yeah. Cool. So on our agenda on September 30th, our partner at Anderson Advisors, they've been doing these great workshops. So they have another one. If you find yourself in Las Vegas or need an excuse to go to Las Vegas and work in some tax strategy
Yes,
to maybe make up for some losses.
And your excuse will be, I heard it on Dave Van Horn's webinar. He told us that asset protection might sound boring, but it's super important.
Yeah. Wait till I tell Mrs. Vanner I'm going to Vegas.
Yep. So that definitely gives you a good excuse to go to Las Vegas. What else have we got, Ryder?
Yes, you can find the details of that on our website, vigsf.com, or on our meetup page. Again, that's September 30th, and it's a full weekend, 3-day thing. Then our regularly scheduled meetup here in San Francisco is on October 3rd. It's a Thursday. Topic TBD. I owe that. So look forward to seeing you guys there next month.
Good. Well, thank you so much, Dave, for taking your evening or almost night over there in Pennsylvania to educate our group on this. And I hope to talk to you again soon, and we'll get that thing with the book for the raffle lined up as well.
Sounds great, guys. Hey, thanks for having me, and have a great night.
Thank you, Dave.
Thanks.
Have a good one.
Have a good one.
Take care, guys.
Enjoy.
Bye.